Welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. I'm your host, Caitlin Cormier. Thanks for tuning in during Investor Education Month here at TD Direct Investing. We're dedicating October to helping you build the confidence to invest and trade. And today's session will hopefully do just that. So some beginners might think it takes a lot of time, effort, and expertise to be successful investors. But what can often make the biggest difference are the right mindsets and habits. Today's guest speaker, Andrew Hallam, is living proof. He reached financial freedom before his 40th birthday, and he did it on a teacher's salary. Now he travels the world sharing his story and helping others realize that they can do the same. We're going to hear all about some of the mind hacks he has for investors that helped him grow his portfolio. But before I dive in, I want to quickly highlight some features of our broadcast platform to help you get the most out of your viewing experience. We have our media player, different kind of things to make the best experience for you, whether it's to make things bigger or smaller. Ask questions. This is a live session. We'd love to have questions coming in during the session. We'll highlight where you can get those questions in. As I mentioned, it is Investor Education Month. We would love you to visit our website at www.td.com/IEM to see all of the great events that we have coming up. We also have the events listed within the platform today, so check that out and register for anything that you're interested in. And finally, social media. Andrew has a ton of social media, so does TD Direct Investing, so check out all those different links and follow us so you can always get the latest content. Okay, with that said, let's welcome our guest speaker and get the conversation going. Joining us is Andrew Hallam. He is the author of 3 best-selling books about money and investing: Millionaire Teacher, Millionaire Expat, and Balance. He also writes for several publications and frequently speaks about personal finance and investing. Andrew, welcome to the show. It is great to have you here.
Thank you, Caitlin. And I owe a huge appreciation to your team who was able to sort out some of these technical difficulties. I left my laptop on an X-ray belt at the Zurich airport on the way to Bulgaria. So your team was awesome because I don't have my laptop.
All right, great. Well, that just sounds like a very interesting start to the conversation. Can't wait to hear some more interesting stories because it sounds like there's going to be a lot. But let's start it with the basics. So I want to start with a really obvious question that I'm sure most of our viewers are wondering. So how were you able to retire a millionaire before age 40? So give us a kind of a quick timeline of how you could accomplish that.
You know, what I did was I was lucky in that I met the right person at the right time who said to me, look, you can do what you want to do in terms of a profession. And for me, it was teaching. I wanted to be a teacher. I met a mechanic who was a self-made millionaire. And at first I didn't believe that. Like, how could you be a self-made millionaire when you are on a mechanic's salary? But he said that if you become financially literate, you can have your money work for you, such that over time, you can invest far more than many other people, but end up with far more wealth. And so I didn't necessarily have to pick a job that was just one that I was choosing because the pay was high, but something that I really enjoyed, which was teaching. So he taught me the difference really between, or how to reframe needs versus wants, recognizing that many of the things in our culture that we end up doing and buying, like material acquisitions, don't typically give us overall life satisfaction the way we often think they do. And so that if we cut back on some of those material acquisitions, like new cars, for example, and only buying used cars, or not buying a car at all if you don't need a car, and actually investing that difference, it can end up compounding over time, especially if you start when you're young. It can compound over time to be worth a 7-figure portfolio.
Wow. So I love that because it makes it feel accessible. Usually we kind of feel like wealth is something maybe that, only the people who have, like you said, those ultra lucrative jobs are able to kind of accomplish. So would you say that there's any kind of exceptional factors or circumstances that helped you retire early? Or do you think that kind of anyone could achieve this with the right approach?
I think most people with like at least a middle class income can achieve this if they learn early on to get their money working for them. especially if they start this, Caitlin, when they're young, because money compounds so powerfully. Albert Einstein says it's more powerful than the splitting. Said it was more powerful than the splitting of the atom, and I can really see that when you play with a compound interest calculator and you start looking at how money compounds so prolifically over time when you have time to get it going to your benefit. And I guess I'm living proof of that. And so too are so many other people who started investing when they were young.
And we're going to dive into some of those examples, and I know you cover them in your books as well. They're just kind of mind blowing when you really can kind of look at the how that works, right? How things can kind of just grow so quickly. Um, Now, you've given us a little bit of a sneak peek. Obviously, you have a very interesting life that you're living currently. So you keep really busy. Why do you continue to work even though you're financially free and you don't really need to anymore?
I don't work in a traditional sense, which doesn't mean that I won't one day again do that. My wife and I are currently in Bulgaria. She hasn't worked for 10 years. And she has taken a job at an international school doing a maternity leave for the next 9 months here in Sofia, Bulgaria. And what work does is it gives us a sense of purpose. It keeps us learning. People who just retire early and sit down and do very little don't feel as much life satisfaction as those that wake up in the morning with some kind of purpose, whether it's a volunteer work or whether it's just a part-time work fulfilling some kind of passion project. So for me, it also allows me to stay engaged with other people. And I just tend to enjoy it, but I get to work on my terms. And that's, I think, the most important part. So I'm not necessarily sitting through meetings that I have to be sitting through, be in places I don't necessarily want to be. So I think building financial independence at a relatively young age has given me that luxury.
It's interesting because it's usually when we think about finance, we think of stress and kind of gets you maybe a bit anxious, but you sound very zen. Everything you talk about kind of sounds like you're doing things you want to do. You're having a comfortable life. It's so we definitely want to get down to some of those brain rewirings that we need to do to kind of get into this headspace. So let's get into the heart of the conversation. Let's learn about how we can rewire our brains for this success and happiness. So one of the first mind hacks for investors is to consider the opportunity cost before making discretionary purchases. So can you give an example of how something small, as far like small purchases, can kind of compound over time to kind of turn into meaningful amounts of money?
Yeah, opportunity cost is a great way of putting it. An opportunity cost really is that difference between making decision A over decision B. And so I give an example of massages. My wife and I are addicted to massages. And I'm not saying that the money we spent on massages was a waste at all. I'm just saying that when we make a decision to spend money on something, anything, it's really important to look at what the overall financial opportunity cost of that decision really is. And then once you know what the long-term opportunity cost of that decision is, you can then determine whether making that decision truly aligns with your values. And so just to give an example that I talked about in my book, Balance, and then I talk about that in many of the talks that I give, it's the idea that my wife and I, first of all, it looks like you've got a cool screen there that actually showcases this. We spent $150 a week on massages from 2003 to 2014. And there was this Malay Singaporean woman named Juliana who used to come to our home. We were living in Singapore at the time, so I was teaching at a private school there. And she would come to our home every Wednesday, and it was amazing because I would run back from school through the jungle and then have a quick shower and then just flop down onto this table. And so after I had my massage, my wife Pally would have her massage. And even on the weekends, occasionally we'd go down to Chinatown, and I guess we were kind of hedonistic. We'd have these like foot rubs. And I looked at the overall cost and I realized, hang on, this is $150 a week. And if I looked at the rate of return on our investments, and I figured, what if that money were actually invested instead of spent on massages? And I'm not saying that it should have been. I'm just saying, what is the overall decision of those massages from 2003 to 2014, what did it cost our overall retirement? And so you might look at it and go, oh, well, it was just $150 a week. And everybody's got their $150 a week. There's a thing that they spend money on that maybe they should, maybe they shouldn't, but to recognize what the overall cost to that retirement could be if that money were invested is something that's really, really important to do. And so what I worked out was that over that time period, the massages cost something like $79,000. So that's just at face value, what we actually spent on massages over like an 11-year time period. But then if I look at how much money we would have made if we invested that in our investment portfolio, it would have come to something like $170,000. And so you might say, well, okay, that's got to be the opportunity cost of Andrew and his wife having those massages for 11 years. But that's just the beginning. Because if we have that $170,000, and at the time we left Singapore, that was 2014, so I was 44 then. If I were able to continue to have that money make money for me, and if it were continued to be invested in a portfolio of low-cost index funds, and let's say I earned, an 8.5% return, what would be the worth of that money? What would that money be worth by the time I was 65? And it came out to about $770,000. So I'm going to reframe this really, really clearly. The decision for us to spend $150 a week for just an 11-year period has had an opportunity cost with respect to our future retirement of about $770,000. So I'm not saying that we shouldn't have spent that money on massages. But what I am saying is that it's super important for all of us to recognize that the money that we might waste in certain areas, perhaps areas we're not getting a lot of value out of, if that money were invested, it could end up growing to quite a substantial amount.
Yeah, wow, that is so substantial, right? When you think about it, even if you cut it down to like bi-weekly or something, right? You would still, knowing that volume, it wouldn't be the same, but there would be such a huge amount of growth in that money if you were to invest it instead. So wow, it's amazing what compounding can do. You're right, that illustration on the screen really kind of shows it there, kind of the base money and then how much it grows. Next mind hack that we've kind of picked out here is investors to reframe how they think about the riskiness of saving versus investing. So you write in your book Balance that keeping money in a savings account for a long time is actually much riskier than investing it in stocks and bonds. So how could that be?
Oh, yeah, that is 100% true, Caitlin. If you put money in a savings account, you're not going to beat inflation. So basically, money in a savings account is losing to a box of cornflakes. And it is kind of funny, you'll talk to some people who will say, oh, some older people, they'll be like, yeah, back in the day, I remember when a savings account paid like 11% interest. And that's true. I remember being like 10 or 11 years old and opening up my first savings account with my mom. And yeah, the interest rate on that was like about 10 or 11%. However, that year inflation in Canada was about 12%. So the interesting thing here is that regardless of what the rate of return on that savings account is going to be, you're going to lose to inflation. And so the biggest risk is losing to inflation overall. And if you're stuffing money in a savings account for your future, now I'm not saying money in a savings account is a bad thing. It's important to have some money in a savings account. Like the idea that you would have, say, 3 to 6 months worth of living expenses in a savings account for emergencies is a really good idea. Having some money that you put into something guaranteed, if you're saving for a down payment on a home, hopefully you can find something guaranteed that'll give you a higher rate of return than a savings account will. But that too is prudent. But when we're putting money into a stock and bond market investment portfolio, we're continuing, especially when we're continuing to add money and we're taking advantage of dollar cost averaging, we're most certainly going to be thumping inflation over time. So Therefore, that is far less risky than money in the savings account.
It's amazing to think about that, because I think a lot of people just don't think about inflation. But if we think of the last couple of years, we've really seen it in real time, right? Like with everything increasing and getting so much more expensive, looking at grocery bills and these sorts of things over the last couple of years, I think probably everyone on this webinar can understand what inflation is. So it's kind of adding that into the investing conversation at the same time, right?
Exactly.
Yeah, awesome. Another habit that you suggest for young investors is to automate regular contributions to the investing accounts so that they're investing no matter what the market is doing. So I have to say for myself, this was huge. It's like paying yourself like a bill or paying your future self, kind of putting your money aside. So tell us a little bit about how this can help investors outperform over the long term.
Well, one of the things that we need to recognize too is just the importance of getting our money working for us as soon as we have it, and not necessarily waiting until the end of a year or just before RRSP contribution time, where we go, oh, look, what do I have that I can actually contribute to my money or to my investments? If you can make your investing automatic, treat it like a tax, overall, you're going to end up far less wealthy because you remove the decisions. And if you are doing that, you're going to be dollar cost averaging, which means if you're investing a regular sum every month and you're ignoring the vicissitudes of the stock market, the up and the down, your money is going to buy fewer units when prices rise and a greater number of units when prices drop, therefore allowing you to buy at a lower than average price over time. So doing that is a great way to compound your wealth. Just as soon as you have the money, invest it. And if you can invest on autopilot, that's the most powerful recipe of all.
Yes, absolutely. I completely agree with that. I think for me, that was one of the best things when I first started investing, is getting that done and then increasing the amount over time. And the great news for everyone who's watching today, if you are with TD Direct Investing, you can automate right through WebBroker. So you don't have to call anyone or fill out any paperwork. You just go onto WebBroker, choose a transfer, and then you can make it recurring. And then that way you can kind of make sure that you are taking care of yourself, that you are paying yourself, and kind of putting that as a priority. So definitely one of those important things. Okay, another mind hack for investors might sound a little bit provocative at first blush, that investors don't need to put a lot of time and effort into outperforming the pros over the long term. And we think about sports and all these other things. It's very hard to outperform the pros in those areas. So it definitely sounds too good to be true. How is this possible?
If the market earns 8% in a given year, what it means is that every professionally managed dollar in that market would have earned an 8% return before fees, because they represent the market. So all of the hedge fund managers and the mutual fund managers and the day traders and all the people with the fancy algorithms, if the market earns 8%, as a group, they have to have earned 8% because they represent the market. So how do you beat the average professional? Invest in the market itself, because the average professional obviously is being charged for charging fees to invest those products. So for example, an actively managed mutual fund in Canada might charge a 2% annual fee, whereas you could buy a stock market ETF that might charge you as little as 0.05%. So over virtually any 10-year period, you're going to beat 80 to 90% of investment professionals if you have a diversified portfolio of low-cost ETFs.
Wow, it's so it's amazing to think about that a small fee can make such a difference, and that something so easy as just investing in the market can be better than some of those really strategic decisions as far as investing can go, and following the pros. So I think that's hugely impactful, especially for beginning investors, right? To know that they don't have to pick the exact right mutual fund that's really niche and focused on a specific area, to be able to just choose the market. I think probably takes a lot of stress off of an individual when they're investing.
It does. And just to add one more thing to that too, Caitlin, is there are those people that will say, okay, like if I were selling, if you're listening to this right now and my job was to sell you actively managed funds, and you would say to me like, oh, I read one of Andrew Hallam's books, I read Millionaire Teacher, or I read Balance, or I heard him on a podcast, and he says that, I'll beat 80 to 90% of professional investors over my lifetime if I buy low-cost ETFs or low-cost indexes. And then what I would do is, if I were selling these to you, not that I am, but if I were selling actively managed funds to you, I'd say, oh, you know what though? I can find you actively managed funds that have beaten the indexes over the last 1, 3, or 5 year period. I'm not going to just get you into average actively managed funds. I'm just going to get you into the best ones. And this is a sales tactic that's often used by financial services companies. But there's something called reversion to the mean. And it means that which performs well during one time period typically underperforms during the next. If you want to have a look at how the data works out, check out the SPIVA persistence scorecard. So every 6 to 12 months, SPIVA, which stands for Standard & Poor Indices versus Active Management, looks at the top quartile of actively managed funds in the United States, and then goes forward a few years, 3 or 4 years, to determine what percentage of those previous top quartile performing funds are still among the top 25% of performers. Generally, it turns out that between 0% and 5% maintain their top quartile ranking. So it's a fascinating thing, because in the world of dentistry, for example, if you have a good dentist, if your dentist is in the top 25% with respect to their skill level, 2 or 3 years from now, unless they have some sort of major issue with their personal life or a major health concern, there's a really high likelihood that that dentist is still going to be in the top 25% of professional dentists. But it's not the same with money management, because of the element of luck that goes into the stock picking element. Yet what do? When buying actively managed funds, most people will buy actively managed funds based on how well they performed in the past. And the reality here is, for the best odds of success, ignore all that and just invest in a portfolio of ETFs.
If we all had that crystal ball, if we could just see what was going to happen in the future, we could make such better investing decisions. Let's move on to another of your kind of mind hacks for investors, and that's to cheer rather than fear when the price of their investments falls. So how could lower prices be a good thing for long-term investors?
Oh, when the market drops, one risk that people face is that they stop adding money to the markets. And we need to think about the markets like a supermarket sale of non-perishable goods. And it's really weird, because if you think about it that way, imagine going into, like, you're a regular purchaser of whatever, canned tomatoes, and you walk into the supermarket and you're like, canned tomatoes are on sale, or price of canned tomatoes is down 20% or 25%. I'm not buying canned tomatoes this week. I'm going to wait until the price of the canned tomatoes goes back up. In that context, it just sounds ridiculous. But that's exactly how people are with respect to the stock market. Well, I'm going to wait for the markets to stabilize before I'm going to invest my money. Mm-hmm. I'm not going to invest right now because my portfolio is dropping. When the portfolio drops, or when the markets drop, this is just a golden opportunity to not only add the same amount of money that you're continuing to add every month, but if at all possible, if you can come up with some extra money, throw that in as well, because the markets are kind of like a catapult. If you can imagine an ancient catapult, and if it's in the down position, the more assets you can shovel onto it while it's in the down position, the more money you're going to make eventually when that thing shoots skyward. Turn on the television at a hotel, and there's some kind of investment news channel, and they'll say something like, well, investors lost today as the Dow tumbled 4%. We need to reframe that. If we're adding money, to the markets on a regular basis, meaning if we actually have an income and the market drops, we need to reframe that to investors win today as the Dow dropped 4%. That's how we need to see it.
Yeah. Yeah, it's when you you make that analogy of the tomatoes and getting upset about something being on sale, it just kind of makes you really rethink it, because that's absolutely right. Like, we know the price is going to end up going back up in the future. So, why wouldn't we take advantage when everything's on sale and get excited, rather than start, getting panicked and getting rid of stuff and not investing additional money. So I love that. Speaking of fighting that fear, one of the interesting points you make in Millionaire Teacher is that investors may want to choose an asset allocation, or kind of that mix between stocks and bonds in a portfolio, that's a notch more conservative than they feel they can tolerate. So how could that help them boost their returns?
That's a funny thing, because if you look at a portfolio of 100% stocks, let's say, over long periods of time, that's your best performing allocation, versus somebody having, let's say, for example, 70% stocks and 30% bonds. The bonds act a little bit like an anchor. So they prevent returns from being as substantial over time. But that portfolio of 70-30 ends up also being less volatile. And so one of the things that I looked at, which I found fascinating, is I looked at the performance of the S&P 500 over the 15-year period. And I found that over the measured period, the S&P 500 averaged 8.24% over this specific period of time. But what Morningstar does, and Morningstar is a fund rating company that publishes fund returns, and it also determines an estimate of how investors performed in each of those given funds. And this in itself points to how irrational human beings truly are. Because if a fund averaged 8.24%, Caitlin, over a 15-year period, and people were rational, what return would they have earned? They would have earned about the return of the fund itself. So they would have returned 8.24%. But we're not rational. Right. So we like to buy things, or we like to spend more money on things that have gone up in price and less on things that have gone down in price. So when the markets rise, people feel better about their investments. They add more money. When the markets drop, they don't feel so good. Sometimes they sell, or sometimes they just cease to add fresh money until the market, quote, recovers. So as a result of this crazy behavior, and it's an innate human behavior, when looking at say a 15-year period that has had some big significant drops in it as well as some rises, you'll find that the typical investor actually underperforms the funds they own. In this case, with the S&P 500, they actually underperformed the S&P 500 by about 2.8% per year. So just to clarify, investors in the S&P 500 over that 15-year period underperformed the S&P 500 over that 15-year period by just about 3% per year. So and this was an interesting case when I looked at Morningstar's cash flow analysis of people that had all-in-one portfolios. So they're a bit more diversified, or much more diversified, because they'll include an element of bonds as well as stocks. The funds themselves, because they had bonds as an anchor, didn't perform as well as the S&P 500. However, the average investor in those diversified portfolios over those 15 years actually beat the average investor in the S&P 500. And in large part, it was that it sort of collared their inner knee-jerk reactions to freak out, because the diversified portfolio dropped less during market declines. And so I'm not saying everybody should have a diversified portfolio, including bonds. But what I am saying is that most people overestimate their tolerance for market volatility and staying the course and not doing something silly.
Wow, that is so eye-opening. I mean, it makes complete sense when you say it, but I never would have necessarily thought that. So it kind of goes to show it's not just the type of investments, but it's how you're investing in those type of investments that really makes a huge impact.
Right.
Wow. That makes a lot of sense. We're going to hop into some kind of a fun part of the session where we're going to go into some clips and kind of get your take on them. But before we do, I just want to ask our audience, are you enjoying the show so far? If you are, then make sure to subscribe to TD Direct Investing's YouTube channel. And if there's a topic that you'd like to learn more about, let us know in the comments. Plus, follow us on Instagram at TD_Direct Investing to get a sneak peek at upcoming shows and a ton of other content designed to help you build your investing knowledge. Okay, we have a quick clip here from Roxanne Lepene from TD Asset Management. So she's suggesting there could be value in holding alternative investments beyond stocks and bonds in a portfolio. So let's see the clip.
If you think about the decade that we were in the 2010s, it was very low volatility when it came to inflation, low volatility when it came to growth. It was kind of smooth sailing, really. But now a lot has changed in the past few years. And we really do think that we're probably going to be in an environment with higher volatility of growth, higher volatility of inflation for, potentially an extended period of time. And so basically, because of that, you want to think about different exposures like alternatives, for example. And the goal being not only just, improving the returns, but reducing risk.
All right, so kind of an interesting take, talking a little bit about different types of investments outside of what we've discussed, just kind of equities and fixed income. So with the idea that markets are changing, what's your take on that?
Well, I'll say what Warren Buffett would say. So I'll respond the way Warren Buffett would respond to that. He would say, first of all, nobody can see the future. So to say that we're going to get high growth volatility, peer-reviewed academic evidence suggests that nobody can accurately, consistently predict what's going to happen in the future. If you're looking at alternatives, let's take an example of something like, well, let's take gold. Can I use gold as an example?
Sure.
Many people will think, well, gold is something that's stable. The irony there is that long-term, gold has barely matched inflation. In fact, gold and many alternative investments are far more volatile than the stock market itself. So over the past 50 years, gold has had more drops than the US stock market has. It's actually also had more drops exceeding 10% than the US stock market has. So I think one of the best things to do is just to stick to a diversified, globally diversified portfolio of stock and bond market ETFs, or if you don't want the bond element, just keep the stock market component. You own the entire world, and as a result of that, you are going to beat 80 to 90% of actively managed professional investors over your lifetime. There's no need to muddy the waters. There's no need to start adding more complex instruments to your portfolio, because once you start to do that, you run the risk too of chasing past performance. And so this is one of the biggest risks that investors face. It's not necessarily how the markets are going to perform. The biggest risk investors face is the person they see in the mirror every day.
Themselves, yeah, wow. Very interesting. It doesn't surprise me that that would be your stance, just based on the conversation so far, that kind of the keeping it simple and straightforward and investing on a regular basis is going to get you there. So I'm going to find out what your opinion is on this one. So this one is coming from DIY investor Joyi Yang. She really likes dividend stocks, even though they're typically seen as something for older investors. Let's take a look.
I'm not spending those dividends. I'm not pulling that money out to spend, right? I'm reinvesting the dividends. And because I'm younger, I have less capital. And so it's so much easier for me to just invest, $50 here and there or $100 here and there and grow those dividends. And hopefully when I retire, I will have that much capital in the dividend stocks that will pay me.
Okay, so what are your thoughts about younger investors investing in dividend stocks as opposed to those types of companies that are purely focused on growth in their business?
Well, I think if you have a fully diversified portfolio, you already have everything within it. You have value stocks, you have growth stocks, you have stocks that pay high dividends. Your portfolio of indexes pays dividends as well. And so when these companies pay dividends, we receive that and roll that back into basically purchasing more shares, especially if we have an accumulating dividend ETF. So even if we don't, if we get dividends into cash, then add that cash to money that we're adding to the markets and then reinvest that. So generally in Canada with our brokerages, we can automatically reinvest our dividends anyway. And so with our diversified portfolios of ETFs, that's exactly what happens. It's riskier to buy individual stocks than owning the entire market, because we're basically putting ourselves up against the professionals then. We're saying, I'm going to do this because perhaps I can actually beat the market. But we know that overall, when we're looking at capital appreciation plus dividend growth, that the vast majority of professional investors who do this full time over a long period of time underperform the market. So that's a peer-reviewed, irrefutable premise. So for me to, for example, buy my own shares or select my own shares based on what I feel will give me higher overall returns, academically, the odds are lower. It's not to say that it can't happen, but the statistical odds are far lower.
That individual stock picking piece, just like you said, it's very difficult to know what an individual company is going to do versus if you're just investing in the market as a whole. It's definitely an interesting for sure. Okay, we have some questions. We have a poll up on the screen that we want our audience to kind of choose which of the questions they would like you to answer. So go ahead to our audience and pick which one of those questions you would like us to answer. And we're going to hop right into the question and answer period of our conversation. So we're not done yet. We're going to open the floor. We're going to take questions from viewers. So are you ready to hear what our audience wants to know more about, Andrew?
Yeah, let's hear it.
All right. So let me just see here. We have a first question, and the question is from Joseph. So Joseph wants to know, what is the proportion of Andrew's portfolio? Stock, bond, Canadian, US, global. So what does that breakdown look like that you think of like an ideal portfolio or your portfolio?
Yeah, my portfolio might not be the ideal portfolio for everybody, but it's currently about 34% bonds, so Canadian bonds, and then the rest of it is allocated to Canadian and global stocks. So it's basically it's an all ETF portfolio as well.
Okay, so mostly in the equity side of things, but you've got a little bit of Canadian bond in there as well to give it that take the edge off, if you will.
That's right.
Right. Sorry, go ahead.
Oh, I was about to say that I don't think that there's really any room for going beyond like a 60-40 portfolio, regardless of age. I know that back in the day, there were plenty of people who said that your allocation of bonds should be your age minus 10% or something to that effect. So, I mean, somebody like a 50 or a 60-year-old should have 50% in bonds. I don't necessarily believe that, because that portfolio needs to continue to grow. So when we're adding money to the markets, that's one thing, but our investment lifetime is our lifetime. So if we retire at age 60 and we hope to live till we're 100, potentially there's 40 more years of retirement. That money, we're going to be withdrawing a sustainable amount from our portfolio. So it's not like we sell everything when we retire. We sell small amounts of it. So it could be an inflation adjusted 4%, could be a great base from which to start. But if you're going to be retired for 40 years, you're going to have to make sure that you have at least a 60% stock allocation, at least, for you to have the highest statistical odds that money will last a 30 or 40-year retirement.
Yeah, well, and as you said, like, things are always changing, right? Hopefully life expectancies are increasing and increasing. So then I guess some of the basic rules do need to kind of update based on that as well. Okay, we have a question here from Christoph. So you talked about, sorry, just give me a sec here to get my screen rearranged so I can see the question. You talked about, let me make sure I have the right one here. What do you mean by invest in the market? Do you mean S&P 500 ETF or all cap index, total market index? What about high dividend ETFs? So a question here about what investing in the market actually means.
The ones that I like the most, like if somebody asks me, how should I invest my money? The best odds are those that obviously are indexed. We reduce risk when they're globally diversified. The ones I like best are the all-in-one portfolio ETFs. And so I'll explain why. So first of all, before these products became available, if somebody wanted global diversification, they might buy an S&P 500 index ETF. They might then add an international developed market ETF, an emerging market ETF, and then a bond market ETF. So you have 4 moving parts there. And one of the risks of that, I mean, that's fine. At one point, that was all we had available. But one of the risks there is that when people are adding fresh money to their account, they often wouldn't know which one they should add their money to. And instead of maintaining a consistent allocation, what people ended up doing more often than not is they would add fresh money to the fund that was, quote, performing better at the time. And so, you know, in 2005, 2006, 2007, the fund that so many people would have been adding money to was their emerging market ETF, because it had destroyed the returns of the S&P 500 over the previous 7 years. It had destroyed the returns of Canadian bonds. It had destroyed the returns of international developed markets. But then, too, there's this reversion to the mean that can occur. So that which performs well during one time period often underperforms during the next. So just another case in point, there was a period in 2011, when very few Canadians wanted any part of the S&P 500. And if you're listening to this and you're a new investor, you're like, what? You know, that's crazy. Why would they not want the S&P 500 in the year 2011? And the reason was that, measured in Canadian dollars, it had actually lost money for a decade, whereas the Canadian market had actually earned a pretty decent return over that time period. And again, what do most people do? They were adding money to their Canadian stock ETFs, and they were shunning their US stock ETFs. Then there's a role reversal, but it's a little too late. This is why I love those all-in-one portfolio ETFs. And so now you've got them through Vanguard has a product, several products with different allocations. iShares have several as well. These are all-in-one portfolios that remove that guesswork, and they remove that element of speculation. You have something like 80% stocks and 20% bonds, globally diversified. Just adding money to that and allowing, say, Vanguard or iShares BlackRock, if they're the fund provider, to maintain the consistent allocation removes that, what ends up being a speculative element for most of us. We end up not having to, or not making the same mistakes that we often end up making when we have individual ETFs.
I remember working in the industry and people really favoring the Canadian side of investing around like between that 2009 to 2011, like that sort of era. Lots of people were definitely favoring the Canadian market over the US. And then, like you said, we're a very small part of the whole world. So it's kind of an interesting thing to do, especially kind of moving forward. But no, I like that. TD actually also, if you are especially a TD Easy Trade client, those are kind of the default all-in-one portfolios. We have some in there, and TD has them in general. So yeah, lots of places to find those asset allocation type ETFs and take that manual rebalancing away and let somebody else kind of do the legwork on that. So that's great. We have a question from Michael here. I like this question a lot. We've talked a lot about beginners, but investing success is different for younger folks as opposed to ones recently retired. Are there any suggestions for the recently retired? I think about you talking about the asset allocation, changing. Maybe that's kind of a piece that maybe the recently retired could consider, not to go too, to be aware of how much fixed income they have in their portfolio. But do you have any other kind of thoughts towards those recently retired?
Again, I think, Caitlin, the biggest challenge for retirees, again, isn't so much the market itself, but it is also the person they face in the mirror. And so when I speak to retirees, I find so many of them will shift their allocation after stock markets have dropped. So they may decide, okay, they have a globally diversified portfolio of ETFs, and they're going to withdraw an inflation-adjusted 4%. And so basically what that means is they'll withdraw 4% of their portfolio in year one. And then in year two, regardless of how the markets move or their portfolio moves, they withdraw a little bit more than they did the previous year to give them an adjustment for that year's level of inflation. And just maintaining this pattern throughout their life as they withdraw money. But what a lot of people end up doing is when markets drop, plenty of retirees, because they're in that phase of withdrawing money, they actually do freak out quite a bit. And so they'll end up selling the portfolio and going into cash to prevent the markets from falling further, or prevent their portfolio from falling further. And what that ends up doing is it ends up leaving them on the sidelines more often than not when the portfolio ends up recovering. And so we see that time and time again, that typically investors underperform the very allocation that they have. And that's a big challenge for retirees, because while young people can say and get it through their heads, okay, well, I'm acquiring assets, market drops are good for me. If they can actually rewire their brains to think that, they're on a winner. But of course, once you're a retired person, a market drop is not good for you because you're actually selling. That said, sticking to a consistent, sustainable withdrawal rate is the best thing a retiree can do, rather than speculating when markets move up and down.
Love that. Yeah, that is. I've heard that the term, like, that some of the worst days in the markets are followed by some of the best days in the market. So if you start getting out when it's down, then you can really miss some of that upside and really cap your returns by being, and like you said, it's just fighting the fear thing, right? Continuing to stay invested through those tough times, and being a bit more resilient with your portfolio, I guess. Excellent. Yeah. Okay, I think those are great words of wisdom for our viewers. We can switch over to our poll. We have lots of votes in, so I'm going to go ahead and ask you the top 2 questions that our viewers wanted to hear. So the first one is, how often do you feel an investor should check on their portfolio's performance and rebalance the holdings? So this is interesting because you talked about those all-in-one portfolios, which do take some of that legwork out of rebalancing. So give us your insight on that portfolio rebalancing and checking piece.
I mean, I think that the less frequently we check, the better. And that's why I love these all-in-one portfolios where it just automatically rebalances. But I think too, looking at the portfolio, if you have individual ETFs, the best thing we can do is to buy the laggard. And so by that, I mean, you've established a strict portfolio allocation. And so let's say that your allocation is going to be, I'm just going to make this up, I'm going to say 70% global stocks and 30% bonds. And that's your set allocation. And when you add money to the markets, when you add money to your portfolio, look to see, well, where am I? Is it still at 70-30? If it's not, then I need to bump one of those things up. And maybe for several months at a time, each month, just bump it back up. So you're not having to necessarily sell something to rebalance, but by purchasing the laggard, you're able to maintain a consistent allocation. Now, once the portfolio gets really large, then it's a lot less likely that you're going to move the asset allocation needle all that much with your monthly purchases. So at that point, it's a good idea to look at that portfolio, maybe something like once a year, and say, all right, how out is it? I mean, if it's out by just a few percentages, that's not such a big deal. But if you're out by 10%, it might be a time to manually rebalance it.
All right, that's a really interesting concept, as opposed to kind of doing that annual, to actually be doing it on a regular basis, keeping an eye and making your purchases based on that. That's very interesting. The next question is, what are some of your favorite investing books and resources for beginners? Of course, apart from your own, we know that yours are great resources as well. What sort of things would you recommend for beginners?
I would say anything written by Dan Bortolotti would be really good. So Canadian, he works for PWL Capital. So he started out as a freelance journalist. He wrote for Money Sense magazine. He started the Canadian Couch Potato Portfolio, And then he went into the financial advisory business.
Yeah, so he does a lot of the couch potato, so the idea of that passive investing, right?
Yeah, exactly. So he and Ian McGugan and Duncan Hood were the first people to actually write about it in Canada. So Ian McGugan and Duncan Hood did the first articles on it. And then Dan Bortolotti really picked up that, grabbed that torch and ran with it. He created a fantastic website called the Canadian Couch Potato. And I'm sure if you went to his website, the Canadian Couch Potato, you actually see his book.
Reboot your portfolio.
Reboot your portfolio. And it deals a lot too with the emotional side of investing. So keeping things diversified, not trying to chase individual stocks, and recognizing that the true enemy we face is us. We can't try to predict what's going to happen in the future, and nor can anybody else. So that book has just got such a good Zen-like grounding to it that I think every Canadian investor should read.
You know what? I think at the end of the day, he wouldn't be upset because you remembered the content of the book. If you didn't remember the name, it's more important that you remember the content than the name, right?
The content is golden. Absolutely. The content is golden.
Excellent. All right. Add it to your reading list to our viewers. Go out and pick up that book and get that insight. We have a question here from Peter. And Peter wants to know how do you pick your ETFs?
Well, I mean, ideally, if you're interested in buying ETFs and you're just starting out, buying one of those all-in-one portfolio ETFs is the best way to go, because with one ETF, you would have within it a Canadian stock ETF, a US stock ETF, a developed international stock ETF, an emerging stock ETF, and a Canadian bond market ETF, all wrapped up in the same product. So if you go to the iShares site or the Vanguard site, or you mentioned, Caitlin, that TD has some as well.
Yes. Yeah.
Have a look, see what the allocation is, but those all-in-one products are golden. Ensure that the fees are low. And so looking at something like, say, 0.25, 0.27%, I wouldn't buy an all-in-one ETF that had internal fees of higher than 0.25%. So you'll be able to see what the fees are on morningstar.ca.
Okay, awesome. I want to share that one of my colleagues has added Dan's full name as well as the book that you mentioned in the Q&A box, so everyone can have that there for future, so that you know what to add to your reading list. We're going to wrap there. We've kind of gone through all of our time that we had together. So first of all, I want to say thank you so much, Andrew, for taking the time to chat with us. It has been a great conversation. You have some really interesting insights. While reading your book, I found you so entertaining. It doesn't necessarily read like a traditional financial book from my experience. I really, really enjoyed some of the insights that you shared in the way that you wrote it. So thank you for that, for having such a great book and for the great conversation. Any final thoughts that you wanted to share with the audience?
Well, thanks for mentioning the book. I mean, I do have the names of these all-in-one ETFs that are actually in the book, Balance. And so that would be the book that I published in 2022. And then it talks a lot about life satisfaction too. So looking at not just investing, it gets into that, but then it also looks at sort of the holistic element of what it really means to be successful. So for me, that's a topic that's really close to my heart, because there's so much more to the overall life piece than money itself. It's just part of the process.
Absolutely. It's kind of that key to opening up the rest of the stuff, right? Financial independence helps you not worry about finances and be able to focus on other things in life. Sounds like that's a bit of your sentiment. Okay, to our audience, make sure to check out the upcoming events in Investor Education Month. We would love to have you at all of our future events, so register for anything you're interested in. Again, thank you so much, Andrew. I really appreciate your time. Hopefully we'll have you back again. And to everyone in our audience, we will see you next time. Bye, everyone.
Have more questions? Check out the links to the right and in the description below.